Welcome to the Pro Ticker Deep Dive.
It is certainly a day where the term deep dive feels entirely appropriate. We are wading into some very murky waters this morning.
That is putting it lightly. I mean, if you are listening to this right now, you have probably already looked at your phone.
Yeah, the notifications are just nonstop.
Exactly. You have seen the push alerts stacking up on your lock screen. It is Monday, March 2nd, 2026. And frankly, the screens are ugly.
Very ugly.
We are looking at a sea of red that we just haven't seen in quite some time.
It's a classic visceral risk-off event. You know, you wake up, the futures are down 500 points, oil is spiking, and there's that distinct feeling.
That pit in your stomach.
Yeah, that pit in your stomach that the geopolitical chessboard was just flipped over while you were sleeping.
It feels like a genuine market shock, not just your standard correction.
Yeah.
We aren't talking about a bad earnings report from a tech giant here.
No, not at all.
This feels like the ground shifting under our feet. So our mission for this deep dive is to do what the headlines can't do. The headlines are screaming about war in Iran. We know what happened, but we need to figure out why the market is pricing it this specifically.
Exactly. We really need to dissect the mechanism of the panic. Why is the fear gauge, the VIX, reacting this violently? Why is the inflation narrative suddenly zombie walking back into the room?
Right, the inflation narrative we all thought was dead and buried.
Exactly. And we also need to look at why specific sectors are behaving in ways that kind of defy the standard war trade playbook.
That is the crux of it. We need to move past the kinetic strikes and look at the plumbing of the financial system. Because this isn't just about missiles. It's about the Strait of Hormuz. It's about the Federal Reserve getting boxed into a corner. And it's about whether 2026 just entered a completely new normal of volatility.
It's a massive shift in the macro environment.
So let's start with the catalyst. We know U.S. and Israeli forces struck targets inside Iran over the weekend. But this didn't happen in a vacuum. Walk us through the escalation ladder that got us here.
Right, so it was a rapid deterioration. The spark occurred near the USS Abraham Lincoln carrier group. An F-35C downed an Iranian drone. Now, usually these intercepts are routine.
Right, they happen all the time.
They happen way more often than the public realizes. But in this specific instance, the drone approached with unclear intent.
Unclear intent?
Yeah, in a formation that the carrier group designated as an imminent threat.
Unclear intent is a terrifying phrase when you're sitting on a floating airport in the middle of the Persian Gulf. I mean, it implies a breach of the standard rules of engagement.
Precisely. It represents a total breakdown in communication channels. That kinetic interaction metal hitting metal triggered a pre-planned response package. U.S. and Israeli strikes hit command and control centers inside Iran.
But the strikes themselves aren't the whole story, right?
No, here's where the market panic really sets in. It's not the strike itself. Markets have shrugged off localized strikes before. It's the Iranian counterthreat. They have dusted off the nuclear option of asymmetric warfare.
You're talking about the Strait of Hormuz.
The Strait of Hormuz.
We hear this name every single time the region heats up. It's almost a cliche in energy trading at this point. Tensions in the strait. But I want to drill down on why this specific stretch of water holds the global economy hostage. Is it just about the sheer volume of oil, or is there something structurally unique about the geography?
It is entirely geography dictating economics. Think of the strait not as a sea, but as a funnel. At its narrowest point, the Musandam Peninsula, it's only 21 miles wide.
21 miles doesn't sound that small.
It doesn't, but that figure is highly deceptive. It gives you a false sense of space. The actual deepwater channels, the specific lanes capable of handling a fully loaded VLCC, a very large crude carrier, are only 2 miles wide in each direction.
2 miles. That is basically a rounding error in naval navigation terms. You practically swim that.
It is a needle's eye. And through that tiny eye passes roughly 21% of the world's daily petroleum liquid consumption.
Wow.
That is 1 in every 5 barrels used on Earth every single day passing through a 2-mile lane. If you choke that off, you aren't just delaying some shipments, you are inducing a global cardiac arrest in energy supply.
Now, over the weekend, there were reports of a radio broadcast that seemed to spook the markets specifically. It sounded almost cinematic when I was reading about it.
Yes, there was a broadcast purporting to be from the Iranian Navy announcing a total transit ban. Now, I want to be very clear here. Physically blocking the strait is incredibly hard.
Because it would invite a massive military response.
Exactly. It requires a massive naval presence that the U.S. Navy would immediately target. But, and this is the key insight for anyone trying to understand the market reaction today, they don't need to physically block it to close it.
The insurance markets.
Precisely. This is what we call the soft blockade.
Explain how that works, because I think people assume you need a physical wall of warships and mines to stop global trade.
Not at all. You just need a spreadsheet in London.
Right.
If the war risk premiums from Lloyd's of London or the other major syndicates jump by 1,000%, or if coverage is just pulled entirely because the risk is deemed unquantifiable, the captains cannot sail.
They literally can't afford to move the ships.
The ships stay at anchor. The economic effect on the global supply chain is identical to a physical naval minefield, but it happens instantly. It's triggered by algorithms and actuaries, not admirals.
So the radio incident, even if it was a total bluff, triggers the actuary.
Correct. It radically raises the risk profile. And that explains the velocity of the market move this morning. Which brings us to the scoreboard.
Right. The immediate market impact.
Yeah.
It's brutal out there. Dow futures gave up 500 points before the coffee was even brewed. The S&P 500 and NASDAQ futures are down significantly, over 1.5%. But look at the Euro Stoxx 50. That is their steepest daily drop in months. The Nikkei in Japan got absolutely hammered.
Japan is the canary in the coal mine here. They have almost zero domestic energy reserves. They import nearly everything to keep the lights on.
So they are hypersensitive to Middle East shocks.
Completely. When the Strait of Hormuz is threatened, Tokyo feels the pain instantly. They are the most exposed major economy to a Hormuz closure.
I want to pivot to the fear gauge, the VIX. We haven't talked about the VIX in a long time because, frankly, it's been asleep at the wheel.
Well, it woke up screaming this morning. The CBOE Volatility Index tracks the expected volatility of S&P 500 options for the next 30 days. Essentially, it's the price of insurance against a stock market crash. We aren't at the 2008 levels, and we aren't at the COVID panic highs of 80 plus yet. But the slope of the spike is what's scary. It's nearly vertical.
So what does that vertical slope tell you? Is this just retail panic, people checking their 401ks on a Monday morning and freaking out, or is this the big money moving?
This is what we call systematic de-risking. This is institutional money. When the VIX spikes this fast, it triggers value at risk, or VAR models, at the major hedge funds and banks.
Break that down for us. What is the VAR model actually doing behind the scenes?
A VAR model basically asks one question. How much money could I lose in a single day with 99% confidence? When market volatility spikes, that potential loss number gets much bigger very quickly.
Right.
So to keep that risk number within their legally mandated limits, the computer models force the funds to sell assets to raise cash. It's a mechanical selling loop. They aren't selling because they suddenly hate Apple's fundamentals. They are selling because their risk budget just got cut in half by the volatility spike.
That makes total sense. It's forced liquidation, essentially. Speaking of liquidation, let's look at the casualties. The Magnificent Seven tech stocks are taking a beating.
The rotation is textbook risk-off. Investors are dumping the recent winners. Apple, Nvidia, Microsoft, these high valuation stocks require a Goldilocks world to justify their massive price multiples. An economy that's not too hot, not too cold.
And the world just got very, very hot.
Exactly.
Tesla is down significantly. Broadcom is down. It seems like the AI narrative that has powered this entire market for the last 2 years completely evaporated over the weekend.
I wouldn't say it evaporated, but it has absolutely been repriced. Look, AI is a productivity story for next year. War is a liquidity shock for today. And in a cage match between long-term productivity and short-term liquidity, liquidity wins every single time.
People need cash now.
Right. Investors are looking at a tech stock trading at 50 times forward earnings and asking themselves, do I really want to hold this if oil goes to $150 and crushes consumer spending?
That is the perfect segue, the energy shock.
Right.
Oil is clearly the protagonist of this crisis.
And it is behaving exactly like one. Brent crude surged 6 to 8% right at the open, pushing hard toward $80 a barrel. West Texas Intermediate is right behind it. But honestly, $80 isn't the real problem. The global economy can handle $80. We've lived with $80 oil before. The market is pricing in the probability of the nightmare scenario.
The $150 scenario, that feels like a number analysts throw around just to get headlines.
Yeah.
How realistic is that what-if scenario, really?
Unfortunately, it's uncomfortably realistic. If the strait is physically blocked or even functionally blocked by the insurance companies for even a few days, there is no spare capacity in the world that can quickly replace 21 million barrels a day. The math simply doesn't work.
What about the pipelines? We always hear about the bypass lines when this region flares up.
You have the East-West pipeline in Saudi Arabia, and you have the Habshan-Fujairah line in the UAE, but comparing those to the Strait of Hormuz is like trying to put out a forest fire with a garden hose.
They just don't have the volume.
They can move some oil, yes, but they are absolutely not designed to handle the full volume of the Gulf's daily output. They are a safety valve, not a replacement.
And it's not just oil, is it? We have listeners in Europe and Asia who should be very worried about LNG right now.
Liquefied natural gas, yes.
Yeah.
Qatar is the giant in that room. And where is Qatar? It is inside the Persian Gulf. If you cork the bottle at Hormuz, the Qatari gas is trapped.
That connects directly to the inflation argument we need to get to later.
It does, because that means electricity prices in Tokyo, heating prices in Berlin, and industrial feedstock costs in China all go vertical. It is an inflationary bomb that hits almost every sector of the global economy simultaneously.
Which brings us to where the money is currently hiding, the flight to safety. Gold is up, which is boringly predictable. It's the classic panic room asset. It climbed about 1.8% to new highs. But silver.
Silver is the absolute star of the show today. It's up nearly 70% year to date, and it just gapped higher on this weekend's news.
70%. That is crypto-level returns on a physical rock.
Yeah.
Why is silver outperforming gold so aggressively right now? Is it just pure speculation?
It's structure. Silver has this unique split personality. It's gold's volatile little brother, a monetary safe haven that people buy when they lose faith in the fiat currency system. But it is also a highly critical industrial metal for electronics, solar panels, and defense tech.
Ah, so you get a double squeeze.
Exactly. In a war scenario, you get the panic buying for the safe haven status, plus the supply chain hoarding for the industrial use. It's a massive squeeze from both sides on a market that is fundamentally much smaller and less liquid than gold.
And the mining stocks are leveraging this move.
Big time. If you look at companies like Newmont or Agnico Eagle, they are up more than the metal itself. It's a concept called operating leverage. Their costs to dig the gold and silver out of the ground are mostly fixed. Diesel, labor, heavy equipment. If the price of gold goes up $100 an ounce, that's almost pure profit flowing directly to their bottom line. Investors know this math, so they pile into the mining stocks for that extra beta.
Now, I have to play devil's advocate here for a minute. For the last 5 years, I have been told by every crypto enthusiast on Earth that Bitcoin is digital gold. It is the definitive asset you hold when the traditional fiat system is crumbling. The system looks pretty shaky this morning, but looking at the charts, Bitcoin dropped initially.
Disappointing is a polite word for it. Bitcoin is down in lockstep with the Nasdaq.
Why? This was supposed to be its exact moment to shine.
Because the pitch is marketing, but the reality is correlation. Right now, institutional money treats crypto purely as a risk-on asset. It behaves exactly like a speculative tech stock. When liquidity dries up, when institutions are genuinely scared, they don't run to digital codes. They run to the US dollar and they run to US Treasury bonds. They run to the most liquid, regulated markets on Earth.
So they are selling Bitcoin just to pay for their margin calls elsewhere.
Exactly. It's the margin call effect. You sell what you can, not necessarily what you want to. And crypto is liquid enough to sell 24/7, so it gets dumped over the weekend to cover bleeding positions in other asset classes. Until the geopolitical dust settles, Bitcoin is trading like a volatile tech stock, not a gold bar.
That is a tough pill to swallow for the true believers. Let's pivot to the sectors that are actually popping champagne today, the winners. And it's grim to say, but war is a very reliable business model.
It is the oldest business model. The defense prime contractors Lockheed Martin, Northrop Grumman, and RTX, formerly Raytheon, they are seeing solid gains of 3 to 4% today.
This is that rotation from growth to security.
Correct. The market realizes that in a hot conflict, fiscal discipline goes completely out the window. Governments will print whatever money is required to buy missiles and replenish stockpiles. That is a guaranteed multi-year revenue stream, regardless of whether we enter a recession or not. But there's a second layer to this war trade that I think is actually far more interesting, the invisible war.
Cybersecurity.
Exactly. Modern warfare is entirely hybrid. You don't just launch a kinetic missile anymore. You launch a wiper malware attack on the enemy's power grid right before the missile hits.
The military landscape has completely changed. I noticed some specific threat actors are buzzing in the chatter right now. Groups like famous Chilima and Operator Panda. Now, usually Chilima is associated with North Korea and Panda with China. Why are we seeing them active in a conflict centered around Iran?
It's a fascinating anomaly, isn't it? It suggests one of two distinct possibilities. One, there is a working cyber axis where these nations are sharing tools. Iran effectively buying or leasing North Korean malware kits to use in their own operations. Or two, it's a false flag digital fog.
Meaning Iranian hackers are mimicking the digital signatures of other states.
Precisely. They leave North Korean or Chinese fingerprints in the code to confuse the attribution process.
Creating chaos so the victim doesn't know who to hit back.
Exactly. And because of that attribution confusion, the threat level is flashing red for absolutely every corporation in the West, not just military targets.
And companies like CrowdStrike are the immediate beneficiaries.
They are the digital arms dealers of this era. CrowdStrike, Palo Alto Networks, Zscaler, Sentinel, they are all deep in the green today. If you look at CrowdStrike's adversary hub, they are tracking these nation-state threats in real time. The market fundamentally views these companies as utilities now.
Utilities. That's a huge shift in perception.
It is. Think about it. In a recession, a CEO can cut the marketing budget. They can freeze new hiring. But they absolutely cannot cut their firewall and endpoint protection budget when state actors are actively probing their network. It is non-discretionary spending for basic survival.
Okay, so defense and cyber are the clear winners. Let's look at the other side of the coin, the losers.
Yeah.
Obviously, the travel and leisure sectors are taking a massive hit today.
Travel is in the absolute kill zone. Airline stocks, United, Delta, American VBAs, they are getting crushed by the double whammy.
Fuel costs and fear.
Exactly. Jet fuel is their single biggest variable expense. Oil prices just spiked, so their operating costs are skyrocketing today. And simultaneously, their forward revenue outlook just tanked because nobody wants to book a European vacation when airspace is being restricted and terrorism fears are elevated. Demand evaporates while costs explode.
And I imagine the cruise lines are in the exact same boat, no pun intended.
Carnival, Norwegian, they are dropping significantly, down 8 to 10%. Who wants to be stuck on a giant boat in the Mediterranean or the Middle East right now? It is purely discretionary spending. And in a geopolitical shock, a luxury cruise is the very first line item a family cuts from their budget.
And that bleeds directly into the broader consumer economy. Retailers like Target and Best Buy.
It's the wallet share problem. If the price of gas goes up by $1 or $2 a gallon, that mechanically sucks billions of dollars of disposable income out of the U.S. economy every single month. That is money that is now going into the gas tank instead of being spent on a new TV at Best Buy or clothes at Target. Retail stocks are pricing in that immediate recession in consumer spending.
And that recession fear brings us to the biggest, most complicated macroeconomic headache of all, the Federal Reserve.
This is the absolute nightmare scenario for the Fed. It breaks their entire economic model.
Connect the dots for the listener here. How does a missile strike in the Middle East directly affect a mortgage rate in the U.S.? Because we were so close to a victory lap, weren't we? March 2026 was supposed to be the month we finally got those sustained rate cuts.
The champagne was literally on ice. The market had aggressively priced in a high probability of a rate cut this month. But look at the bond market today. That probability is evaporating by the minute.
No, wait, if the economy is going to slow down because of the war, like you just said with the retailers and the airlines, shouldn't the Fed cut rates to help stimulate things?
In a normal demand-driven recession, yes. But we aren't in a normal world right now. We are entering a supply shock.
Explain the difference.
If the economy slows down because people just decide to stop buying things, you cut interest rates to make borrowing cheaper and stimulate demand. But here, the economy is slowing down because the baseline prices of everything are going up due to the oil spike. It's the mechanics of inflation. Energy is a foundational component of the cost of all goods. Higher oil means higher gas prices, which means higher transport costs for every truck delivering goods, which means higher prices on the store shelves.
Inflation.
Exactly. If oil sustains at these elevated levels, it mechanically adds percentage points to headline inflation.
So the Fed is completely trapped.
They are in a policy straitjacket. On one hand, the war shock slows economic growth, which screams to them, cut rates. But on the other hand, the oil shock causes inflation, which screams, raise rates.
Stagflation.
That is the word central bankers hate more than any other. Stagnant growth combined with high inflation. If the Fed cuts rates into an oil supply shock, they risk repeating the catastrophic mistake of the 1970s, letting inflation spiral completely out of control. So their hands are tied. They might be forced to hold rates higher for longer, even as the stock market crashes and the economy slows.
And that is exactly why The 10-year Treasury yield is rising today.
Yes, bond investors are demanding a higher yield, a higher return to hold government debt because they are terrified that sticky inflation is coming back to eat away their real returns. And as those bond yields rise, they act like gravity on stock prices. Higher yields pull the valuation multiples of tech stocks down. It is a vicious, self-reinforcing cycle.
Okay, we have painted a genuinely terrifying picture here. Military escalation, an oil supply shock, stubborn inflation, and a trapped Fed. Let's talk investor psychology and strategy. What do you actually do? Because my immediate instinct looking at these screens is to sell everything and buy canned beans.
The instinct is always panic, but the strategy must be patience.
That is much easier said than done when you log in and your retirement portfolio is down 4% in a day.
I know. But look at market history. Look at the Iraqi invasion of Kuwait in 1990. Look at the invasion of Ukraine in 2022. In almost every major geopolitical shock, the initial reaction, the panic dump on day 1 or 2, is the absolute worst of it. Markets despise uncertainty. But once the conflict actually starts, the uncertainty transitions into a known variable. The market can price a known variable. And once it does, markets tend to stabilize. The crisis premium usually spikes violently and then slowly fades.
So selling into the massive hole today is likely a mistake.
You are almost certainly selling at the point of maximum fear. Instead of selling everything and moving to cash, you should be rotating your assets.
Rotating to what, exactly?
Yeah.
We talked about the shift from growth to security. Is it just defense stocks?
No, it's broader than that. It's a return to value investing. In a high inflation, high interest rate world, you want to own companies that generate massive free cash flow today, not companies making promises about their profits in 2030. You want companies with deep economic moats.
Pricing power.
Exactly. If a company's input costs go up because of oil, can they seamlessly pass that price increase onto the customer without losing sales?
So you're looking at sectors like utilities, healthcare, consumer staples, the boring stuff. You want to own the things people buy because they absolutely have to, not because they have extra disposable income.
And I assume diversification is key here. I feel like we say this every single time we do a deep dive. But a day like today is the ultimate proof of why it matters.
It is the only free lunch in finance. If your portfolio was 100% allocated to high-flying tech stocks, you are feeling immense pain today, down 4 or 5%. But if you had a balanced allocation, say some exposure to energy stocks, some physical gold, some short-term bonds, those assets are zigging while the tech stocks are zagging. You might actually be flat on a day of historic panic. You hedge your bets not because you possess a crystal ball and know the future, but precisely because you don't. Well, we have covered a tremendous amount of ground today. We unpacked the geography of the Strait of Hormuz, the mechanics of the insurance markets enforcing a soft blockade, and the inflation trap boxing in the Federal Reserve. It really is a perfect storm for the market.
It is a perfect storm, but I want to leave you and the listeners with one final, very uncomfortable thought.
Go on.
We have spent this entire deep dive looking at the water. We're completely obsessed with the physical closure of the Strait of Hormuz. We're tracking oil tankers, naval destroyers, and sea mines.
Right, because that is the headline threat everyone understands.
But we live in 2026. What if the real devastating retaliation isn't physical at all? What if Iran doesn't bother trying to physically close the strait, but instead launches a massive, highly coordinated cyber attack on Western financial and energy infrastructure?
The invisible war again.
Think about the geopolitical calculus. Closing the strait hurts Iran's own allies too. China desperately needs that Gulf oil to keep their economy running. But a crippling ransomware attack on a major U.S. bank, or a wiper malware attack that takes down a section of the U.S. power grid, that is asymmetric warfare. It inflicts massive economic pain on the enemy without immediately disrupting the global oil supply chain that your allies rely on.
And the ultimate question is, are the financial markets remotely pricing in that specific risk?
I really don't think they are. I think the market is fighting the last war. We are pricing in the 1990 war of burning oil wells and blocked tankers. If the next major shoe to drop in this conflict is entirely digital, the extreme volatility we saw on the screens today might just be the warm-up act.
That is a deeply chilling thought to end on. Don't just watch the water, you have to watch the wires.
Exactly.
We will continue to monitor the situation as it develops. For everyone listening, stay informed, stay calm, and always look for the signal in the noise. Thanks for joining us on the Pro Ticker Deep Dive.
Take care, everyone.